Corporate finance practice problem using Excel. Common stock expected rate of return assuming a constant growth rate. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information will be on the left-hand side. We're going to use that to populate the blue area on the right-hand side, looking into the rate of return or required rate of return or estimated rate of return on the stocks with the information including dividends at year end. So we're assuming dividends will be paid at the end of the year at the 580. We have the stock price, which is at the 85, and then we have a constant growth rate, which is something that we would have to assume based on past performance to see if the growth rate is somewhat constant going forward. Given those assumptions, then we can calculate the rate of return, required rate of return. So let's first think about, because there's two things that are going to be involved here, right? One, we have the dividends that are being paid out, which is a rate of return. And then we also have the growth rate, which is also considered due to the fact that if you have the growth rate, you would assume then that would increase the value of the stocks, and the value of the stocks going up would also be a way to have benefit because we could sell the stock and whatnot and receive return in that way. So we have these two factors that are going on. Let's first think about the dividends at the end of the year. This is what is actually being paid out. So obviously if the price was $85 that we put down and we're getting paid a dividend of $6, I'm going to add some decimals. And then we compare that to the stock price. If the stock price is $85, let's underline that, Home tab, font group, underline, and compare that to the dividends that are actually going to be paid out. So we put down 85, we're going to get paid out the dividends at the end of the year. We're assuming at the 580, this is going to be the 5.8 divided by the 85. Let's make that a percent, go into the numbers group, percentifying it, adding a couple decimals, we're about 6.82. So that would be our rate of return if we just consider basically the dividends compared to the price that we would be paying for the stock, assuming to be paid for it. But we also have the growth rate that we want to take into consideration here. So we're going to add that in. I'm going to be picking up the growth rate. It's going to be the 6%. Going to percentify that, going to make it a percent in the number group. Let's add some decimals, underline it, font group, and underline. And so there we have that. And so I'm going to take then the growth rate. We're going to take then the 6.82 plus the 6%. And numbers group, make that a percent and add some decimals. So we're talking more like 12.82 on the rate of return. So once again, two things that are taking place here. One, we have the rate of return related to the dividends, and then the return on the growth rate of the stock, which we assume increases the value of the stock. So we're looking the rate of return at the 12.82. Let's do it again down here. Let's do it another time. We've got then the information on the dividends at the end of the year. We're saying are 210. We could base this on prior information or what the company is basically saying they're going to do with regards to dividends. Stock price $60. We have the constant growth rate now assumed to be the 11%. What would be the required rate of return or estimated return? We're going to say, let's first look at the dividends again. Let's just pick up the dividends, which is more straightforward, which is what's actually being paid to us. Would be the $2. Let's add some decimals, number group, couple decimals. Compare that to the price, which is going to be the $60 price. Going to underline that, font group, and underline. And then if we take then the $2.10 divided by the $60 paid, make that a percent, number group percent, adding some decimals. That's what the return would be if we're just considering the dividends, but we're also considering growth in the stock growth then contributing to the value of the stock, which we now hold and then could sell. And therefore we want to take that into consideration as well. We're saying it's growing 11%, adding some decimals there, home tab, numbers group, let's percentify it, add a couple decimals, font group, underline, and then add those up. Let's use the trusty sum function this time, S equals SUM, shift 9, and pick those up. Then go to the number group, make that a percent, adding a couple decimals, so we're talking 14.5% in our estimated rate of return or required rate of return calculations.